This is Chuck Carnevale. I'm the Chuck in the Markets up, Chuck. And today, we're looking at growth and income opportunities too. A continuation of yesterday's blog, and we'll follow through with this tomorrow as well. Because one of the things that's happening, there's a lot of talk about the stock market and how much it's improved and rallied since March, and people are talking about, corrections, et cetera. And I don't forecast the stock market, so I don't play that game. All I can tell you is I can look at some very high quality, what I call stalwart blue chip companies that have seen their stock price improve. And Kimberly-Clark is a good case in point. The stock price has fallen dramatically below its normal valuation, which is connotated by the blue line here on this 20-year chart. And as you can see, it's rallied for sure, but it's still not back to where it would normally be. Normally, this company would trade at around a 15 to 20 price earnings ratio. It's currently trading at 14 times earnings, and therefore the price could be as high as, into the, say, low 70s to mid 70s. But the point is, because the price is so low and the company has continued to do reasonably well, you can now buy this company with a 4.1% dividend yield. Now, Kimberly-Clark has not been a fast grower. It's only been growing at 5 or 6% a year, 6.5% a year, but the bottom line is you do have some growth potential because the stock is so cheap today relative to its historical norms. At least you're buying it at a discount where there at least is an opportunity to see some short-term appreciation where it reverts to the mean and gets back to normal and then grows from there. Now, interestingly enough, the consensus growth going forward on the company is around 9%. But if you look at the track record of this company, and this is the real purpose of these blogs, is you can see that they've increased their dividend. So we're starting out with a 4% dividend yield right now, which puts us about where we would have been if we looked at 93 and 94 after buying it originally in December of 1990. But what I wanted you to see what kind of growth that this company has generated from that yield. So you can see that the income side has increased dramatically year after year after year. Now, this company did about the same as the stock market in general over the last 20 years, but it does have a rich dividend, and the fact that it's on sale means you're getting a starting dividend that's higher than it's historically ever been. My second example today is General Mills. Again, another very high-quality company. You can start out with a 3% dividend yield. And once again, I want to keep bringing your attention to the fact that the stock price is trading at a significant discount to how the market would normally capitalize this company. It's not huge. It's around 14 times earnings instead of 18 to 20 times earnings. But the point is, you get a nice 3% dividend yield. You get a forecast about an 8% growth rate going forward, and you have an opportunity to see that dividend increase year after year as they historically have. And companies going through the recession now are going to certainly maintain their dividend. Now, General Mills doesn't have the best record of all the companies I've shown you. There are periods where they have not raised their dividend, but they have not cut their dividend either, which I think is important. And they have a long legacy of paying a dividend. And again, they haven't performed. They haven't been one of the great performers, but you hadn't have an opportunity in 20 years to buy them this cheap, which should give you an expectation of a higher rate of return going forward. Now, my final two examples are going to be companies that are also stalwarts, extremely high-quality companies. Clorox, everybody knows it, an $8 billion market cap. But look how inexpensive Clorox is relative to its historical norm. You can get a 3.2% dividend yield, and this company has been a much better performer than the stock market in general over the last 20 years, better than the other two. You get a nice dividend yield, and their dividend growth rate, because the company's earnings have grown, have actually been better than the other two. So again, here's another example of, a group of companies you can put together to build a very high quality growth and income portfolio, thanks to the recession causing the prices to be artificially low. And my final example is Johnson & Johnson. This company has grown at over 12% a year. You can buy it at a 3.1% dividend yield. And if you look at its long-term track record, normally you'd expect to buy Johnson & Johnson yielding somewhere around 1.5 to 2.5% yield. But because the price is so low today, you've got this, kicker where you actually have a dividend yield over 3%, almost paying what a 10-year Treasury bond is. Yet, you have the opportunity to see, the dividend increase with the earnings growth that you can expect this company to deliver over the next, 5, 10, or 15 or 20 years. The company has a much better record as Clorox did in the stock market, has a great long-term dividend record, a great legacy and history of dividend records. And I think the important thing is I believe all these companies are well positioned to continue to pay their dividend. Their dividends appear to be very well protected, at least cursory. However, I do encourage you to do your homework. This is Chuck Carnevale. It's been my pleasure to bring you some more growth and income opportunities today, and I look forward to talking to you again tomorrow. Thanks for listening.